Welcome, everybody, to this first public event organized jointly by the Crypto Valley Association and the CAS Blockchain and Finance. So I'd like to welcome you all. I'm the co-director of the CAS, the Certificate of Advanced Studies on Blockchain and Finance, which is here at the University of Applied Sciences. So for those of you who don't know, it's a university certification for professionals. We're targeting professionals in the financial sector and who are also interested about the financial applications of blockchain technology. And so it's the first university certified program in Switzerland that specifically deals with the financial applications of blockchain. So all the way from the different verticals that the technology is used in to decentralized finance, on-chain analysis, and even the regulatory aspects. And so this conference tonight is taking place on the side of this course, and some of our speakers will be giving a masterclass tomorrow to the participants of the course. So the Crypto Valley Association has the shared goals of the CAS, which is, in my opinion, to broaden the reach and develop our region as a pole, as a hub of knowledge and of business, particularly effective in around blockchain technologies. The Crypto Valley Association is one of the biggest professional associations in blockchain in the world, with over 1,100 members and more than 200 companies across continents. We're very active in terms of events. I just saw that this week, I think just these few days, there are events across 4 continents, if I'm not mistaken. So feel free to check us out and become a member. So for this event, I'd like to thank the university here, the Haute École de Gestion, for hosting us and for providing this beautiful room. And I'd like to thank our friends at Bitcoin Suisse for, well, first of all, because they're one of the founding members of the Crypto Valley Association, and they've been a long supporters of the association. And tonight they have graciously sponsored our networking apéro. And a special thanks also to Women in Web3 group, which is a group of more than 200 professionals across Switzerland who keep giving us a hand and keep finding us great speakers to participate in our events. So thank you for them. So now I'd like to introduce you to our speakers tonight. We'll have 4 short presentations, about 10-15 minutes each, back to back, and then we'll have a panel discussion and a Q&A. So first, I'd like to welcome Olivier Fines. He's the head of Advocacy and Policy Research for EMEA at the CFA Institute in London. And Olivier co-authored a report for the CFA Institute that was published recently, from which I stole the title, at least parts of it, and he was gracious enough to let me do that, and it's called Cryptoassets Beyond Hype. So we'll start with Olivier, if you want to join us.
Thank you very much, Arkan. Thank you all for making the time. This is appreciated. My name is Olivier Fines, as Arkan said. I'm with CFA Institute based in London. And today, what I'll try to do with my presentation is establish an intersection between finance, the world of traditional finance, and the very new world of digital finance and crypto assets. And I have to say, crypto assets, digital finance has been a problem for CFA Institute since the very beginning. We didn't really know what to do with that. We dismissed it as an investment because for us this was merely something to do with payments and banking infrastructure, not something that would eventually be considered by investors as a new asset class, for example. We were wrong on that point. We have observed how crypto has started to pervade the world of investments very rapidly, and also in a much more retail manner than what we had seen in other asset classes. And as soon as this was a reality, retail individuals investing through crypto, this becomes a conundrum and a real problem for the world of investors, for practitioners, but also for regulators. What do we do with this? Do we dismiss it? Do we just tell people this is a scam, don't go into that? Or do we address it seriously? So that is what we have tried to do with the report that Arkan was mentioning. What we wanted to provide is a dispassionate, a rational analysis of what is happening in the world of investments as related to crypto penetration. Our observation at the time, which was about 2 years ago, is that much of the commenting, the public commenting on crypto was very polarized. Either this was the greatest thing since sliced bread, basically, or it was evil and should be banned, right? So was there not a way to look at crypto in a neutral, unbiased manner, looking at what it actually means as a trend for financial services? And this is what we've done here. We tried to provide, through a series of interviews of technologists, investors, asset owners, sovereign wealth funds, can we provide a point of view of investment practitioners and investors as regards their exposure to crypto? And over time, what transpired is that crypto has 3 problems from a traditional finance standpoint, which needs some form of resolution before crypto can penetrate the institutionalized world of investors. We will discuss each one of them briefly afterwards, starting with valuation, the distinction between a market price and what is the fundamental value of those investments. This is intimately related as well to the debate that is taking place in the US at the moment. In other words, what are crypto assets, securities, commodities, or currencies, or something entirely new? The second problem, and this is very core to what CFA Institute is teaching, is the notion of fiduciary duty. You're not making investments for yourself always. You can also make investments on behalf of someone else. In other words, the best interest of that someone else is what matters here. How can crypto align with this duty if you cannot explain risk or valuation? This is a conundrum that needs resolving. And finally, custody, and what we refer to as safekeeping of client assets, is, to my mind, the number one problem that needs solving immediately if crypto is going to be taken seriously. And I know from talking with Aliya that this is something that her organization has tackled, so it will be interesting to get back and forth on that point. Now, when we discuss the notion of value, as a currency is considered a store of value, at least in certain circumstances. Is Bitcoin a store of value, right? So when you compare Bitcoin, relatively speaking, to gold or the dollar index, for example, next to inflation over the last 2 years, it has been difficult to conclude that Bitcoin was actually a store of value, in other words, an inflation hedge. Okay? That has been a problem for those who tend to see Bitcoin as digital gold, for example. Can it protect value in inflationary environment? And we can see here how over 2021 and 2022, that has not always been the case. So what is actually driving the market price of crypto? And here I used an example that took place just a few days ago, on the 5th of February, 2023. That single day, crypto trading volume rose by 25%. We don't really know why, except that a few whales were highly involved in transaction volume that very day. And now that comes in stark contrast to a much more institutionalized world of equities, for example. So we need at some point to be in a position to explain this volatility and those transactions. And if they're always due to very large holders making a move from one exchange to another, that has got to stabilize at some point. In our report, we were also making the observation again on Bitcoin, I'm not saying this is true everywhere, there still seems to be a high correlation between the price, the market price of Bitcoin, and the number of active entities in that coin. In other words, it is possible to think that the number of people getting active in Bitcoin follows the price of Bitcoin. Again, that would tend to contradict the notion that Bitcoin is a means of exchange, right, or a store of value. And as you know, to be a proper currency, there's three characteristics: a means of exchange, a store of value, and a unit of account. It is possible to see that Bitcoin is failing on at least two of those characteristics. So it's not a proper currency in the traditional sense of the term. So instead, how can you value crypto assets, right? So in our own report and in other reports that we've seen, there are various ways, right? So cost of production, the quantity theory of money, there's different ways. It's not true to say that there's no way to value crypto, but which one would be most useful? What we have found so far is that one that stands out is to see crypto as a network, right? In other words, value can be calibrated through the number of active users in that network, and value is related to giving you access to that network, right? So if you go back to Metcalfe's law, in other words, the value goes up as the square of the number of users. And when you take a look at the number of users across the crypto world over time, it has gone up. So there are more and more people using these instruments. We don't have enough information to qualify their use, but it is going up. And from that perspective, the network effect is also rising. So from that perspective, then, if you are an investor, or if you're an institutional investor making decisions on behalf of someone else, why could all that be a problem? So a fiduciary is someone who acts in the interest of someone else, and there could be no conflict between the interest of the agent and that of the principal. So when it comes to crypto, if you're an institutional investor, if you're a wealth manager and you're investing your clients' money in crypto, you need to be able to justify this beyond, excuse me for the pun, beyond the hype that crypto represents. You need to understand the business case that you're proposing. You need to have some element of information on the value of that proposed investment, and you need to have some sort of rationale on the risk. Is this appropriate for someone who is not sophisticated, for example? If you cannot answer those questions, for the time being, we have problem reconciling crypto, in some cases, and fiduciary duty. As you can see here, and this is something that we've discussed with most of the people that we've interviewed for the report, Bitcoin volatility can be difficult to explain. This chart compares the volatility itself of Bitcoin 30-day against that of the dollar-euro cross, the currency pair. There's no comparison between the two. How can I explain that difference? That is something that needs to find some sort of answer or solution. Even when you compare crypto, or Bitcoin in this case, to other markets, gold, copper, oil, the dollar index itself, or equities through the MSCI world, you can see a world of difference between those markets. Again, stabilization of crypto will need to happen for crypto to become, I would say, institutionalized and mature. Now, we will end this presentation on the problem of custody. And for us, this is the number one problem. If a client at any point in time cannot be absolutely certain and obtain guarantees and verification that their assets are being segregated from the risk of failure of the entity holding those assets, this cannot work, right? So we reviewed different ways to access, store those crypto assets, depending on whether you use a broker or a crypto exchange. There's different mechanisms for these coins to be stored. But until now, it has been difficult for firms to justify how those assets were segregated from their own. And so somehow crypto asset services firms will need to raise their standard to match that of traditional financial firms if they want to stand a chance. There's just no way around that problem. So the principle of the segregation, this is a definition that FINRA, the regulator, broker-dealers in the US uses. The segregation of client assets requires firms that maintain custody, they hold those assets, of customer securities and safeguard the cash to segregate these assets from the firm's proprietary business. If you go down, your assets, your client assets remain safe. That is the standard, and this is what crypto asset firms should be aspiring to realize. Whether this is done through organic development or forced through regulation. There's just no way around resolving that problem. So that is the end of my presentation. Again, remember, 3 major problems for crypto in terms of their relationship to traditional finance: valuation, fiduciary duty, and custody. And I hope we can discuss those issues together tonight. Thank you very much.
Thank you very much, Olivier. And this is going to be a really nice intro to our next presentation. Oh no, it's the PowerPoint. So our next speaker is Aliya Gupta, and she's Senior Vice President of Business Development at Sygnum Bank. And Sygnum Bank is one of the 2 crypto-native banks in Switzerland, so licensed and regulated under Swiss banking laws. And I won't say more because now this is a perfect way to continue the talk.
Perfect. So I come from a slightly different background than everybody else who's speaking here tonight. Both, I mean, you can see that I'm obviously not the same physically, but also in terms of the organization that I represent. So I don't know if you guys here have heard of Sygnum Bank before. Maybe just a quick show of hands. Oh yeah, most of you have, so it's fine. But Sygnum actually puts out every year a market outlook report on how we see the trends from the previous year or the key events from the previous year, as well as how we see the market evolve going forward in this year into 2023. So I don't know if you had a chance to look at this report already, but if you haven't, this next few minutes, I'll go over some of the key topics, and if you find something interesting there, you can always go back and read the report in detail. So, the first topic I think that everyone knows and feels really sorry about is how the mainstream adoption of crypto kind of got a little bit ruined last year. We had a lot of great market momentum in 2021, and coming into 2022, we had a lot of optimism about all these big institutions finally coming into the space. And to some extent, they did. But of course, this became a slightly different journey after the middle of the year. And this was primarily because we saw a kind of narrative flip. So crypto was always looked at, until 2021 at least, as a macro asset hedge. And Olivier spoke to this a little bit as well. But going forward, or somewhere around mid-2022, we saw the entire narrative become crypto as a risk asset. And this was honestly a pity, because there's a lot of different, of course, risk assets out there, but it didn't really do justice to where crypto was going and also the sorts of events that happened that caused this flip to occur. So I don't need to cover these, right? Everyone knows what happened first with Terra, with Celsius, 3 Arrows, FTX. All of these events that occurred were largely crypto-generated, crypto-precipitated. They didn't really have that much correlation with the broader macro outlook. And so when we looked at the rate hikes, so you looked at, all these, the narrative of this recession coming up, those things didn't actually impact the crypto fundamentals. It was really all of these big events that came from inside of crypto that caused this flip to happen. And hopefully, going into 2023, we'll see a sort of recovery back to the track that we want to be on. The other important one, of course, is that being a young market, there's a lot of experimentation that occurs, which of course means that experimentation comes by definition with some things that go well and then some things that maybe don't go so well. And one of these, for example, was the weakness that we saw in certain business models. So the play-to-earn model was really, really hyped back in 2021. Everyone thought it was the next big thing. And then somewhere around 2022, we really saw that this doesn't actually hold up over a period of time without it being playing out a little bit like a Ponzi. And so, not to say that play-to-earn is dead. I think there's a lot of hope and scope there. But I think it exposed that there was a lot more work to do in how these business models are actually structured. The other really cool takeaway, I think, from last year was to see the dominance of the layer one sector falling. And that is to say, we actually have a lot of focus now on building applications where these trustless systems bring actual utility. So layer one was, of course, just the infrastructure layer. And it's great that it works, but it really shouldn't be the core driver of the market. It's there, it serves us, and then what can we build on top of it? And that's what we started to see happen last year. What hasn't changed? And what I would like to point to, of course, is the institutional commitment. So we've had a lot of players that came in loudly and noisily in 2021. And in 2022, early 22, we saw them still coming in. And in the second half, they were there, they were just a little bit quieter about it. They're maybe not talking about it so loudly on the marketing side, but the commitment to the space didn't fall. And that, of course, is what we see as quite a bullish sentiment. And in line with that, there was quite a lot of price resilience. So even though this chart obviously is not very pretty, we see it slide downwards. Each big market event, so you see the cliff and then the straight line, the cliff and then the straight line. These sort of show how the people who came for the technology continue to stay. Of course, the day traders, there are people who got scared of what was happening on the macro scale. But fundamentally, I think the people who are really here to see the crypto evolution play out continue to hold and are here for the long run. So we all here build in a bear market. That is what happened, I would say, in every bear market so far. But this year, we would say it's a little bit different. We call it a reluctant bear market. That is the kind of existential questions that were asked before. So, crypto is dead, or there's no point to this, or it's a problem looking for a solution, or it's a solution looking for a problem, and all of these sorts of questions that were really hyped up every bear market so far. They're a lot less this time, or arguably not really there at all. So that doesn't mean everything's rosy and great, right? We're still living in a pretty uncertain world. So one of these is that the contagion from last year isn't completely done, we think. Like, we're watching DCG play out in front of us right now, and Binance continues to be a bit of a question mark, as does Tether. And on the other hand, I think there's been a lot of fairly justified criticism about the centralization of a lot of crypto platforms. And one place where you can see this is, for example, the share of Ethereum staking by each platform. And to see Lido have over 30% of what we pride in being one of the more decentralized solutions out there, that is something that we are also seeing solutions to. So we see this as a problem, but you also see players like Rocket Pool who prioritize decentralization gaining traction and market share. So where does the value lie going forward? On one side, of course, I think scalability is, we're getting there. There are solutions for scalability, but I think as this year proceeds, after the Shanghai upgrade, we get to the splurge, I think, with proto-dank sharding with Ethereum. And then we really start to see the kind of scalability that we need for a lot of the larger applications to roll out. I think utility NFTs is a really big topic. I think everyone's waiting to see how these get implemented, and more the use case for them becomes clear. Particularly, if you saw the Taylor Swift debacle with Ticket Corner last month. Security and identity, I think, are also really important topics, because on one side, of course, security, I don't need to say why that's important, but with the rise of zero-knowledge proof technologies and them coming more into the forefront with their mainnet slowly being deployed in the next months going forward, we will be able to bring that idea of compliance to crypto without necessarily giving up privacy as well. So then identity with zero knowledge coupled together, I think, is a really strong solution for value going forward. I already mentioned the Ethereum upgrades, and the collaborations point, I think, actually refers mostly, for me at least, to the NFTs. Or so when you have a big mass of people who maybe engage already with a Web2 player, so I'm thinking about how Instagram brought in NFTs, or Reddit is doing something with NFTs. All of these bring those sort of triggers for mass adoption of Web3. And I think that's going to be very exciting to look at as it evolves. I wanted to talk really quickly also about the VC side of things. So last year turned out to be a record year in VC funding. Of course, this was very front-loaded. The last quarter of 2022 was, I think, levels that we haven't seen since 2020. And also, I think what was important was a lot of the projects that were associated with big VCs were the ones that actually suffered quite a lot. So VCs kind of got a little bit of a bad name in this space because of the centralization that they bring, and also for pushing up or pumping up projects that maybe weren't organically that strong. However, what we've got today, therefore, are lower valuations. And these lower valuations, it's caused a correction, which I think was necessary in the market, because now we've got a lot more focus back on fiscal responsibility, on due diligence and how things are set up. And that, of course, leads to stronger products being built. And so that means, if you look back at 2017, that was when we saw really young, strong teams with a lot of conviction and great ideas get funded for the sort of big outsized returns that we saw in 2021, early 2022. And that's a little bit where we see ourselves now, again, today. Just as a last slide, what we think about, the way forward. CeFi upgrades, so as Olivier was talking about, I think CeFi has a lot to answer for in 2022, and so in 2023, it's going to be a real competition of how transparent you can be. We all know transparency is much better than regulation, though both go hand in hand. And similarly, greater compliance, so ways to access DeFi without necessarily being completely anonymous. We'll expect to see greater dispersion, so markets driven by projects and the outcome of these projects rather than just big macro shocks that we saw happen last year. And the best part of a bear market really is the focus on value. So to go back and understand what utility can this trustless system bring, what can it be used for, where's the value for it, and therefore how can it be built and developed into something that people can use and benefit from. So this is a very high-level overview of what we covered in the report, but of course, I hope to talk also to my fellow panelists later this evening on how they see the market evolving. Thank you.
And so our next speaker will be Florian Rais. And Florian Rais is the CEO of Criptonite Asset Management Company. It's an asset management company that's Swiss-based, regulated by FINMA, and specialized in digital assets.
Thanks. So to mark a difference, first of all, I'm not having a presentation. So I'd like to share with you a couple of things. First is just what we have intended to do. So 5 years ago, in 2017, we, on two sides, almost at the same time, in Los Angeles and here in Geneva. Los Angeles, they decided to go to the crypto asset management, and here in Geneva, I decided to go into asset management, and I would like to share you why, and why actually we think it matters. 20 years earlier, I was at Pictet, a bank that you might know, and we were having the internet and the .com. That was our bread and butter every day, internet.com. And I remember I believe it was UBS, who was saying that for those who were using their UBS credit card on internet, you had your card cancelled and your account closed and everything because it was bad, right? You could possibly only use online services for something that is not proper. Sounds familiar, right? With crypto today. So back in the years, I said, well, you know what? The problem we had is we were a very traditional bank. So our clients were coming more and more, actually, and saying, we'd like to invest into this thing called internet. They would like to invest into those .coms that are all flourishing and coming. And we were very embarrassed because we're looking at the people and they say, well, yes, a good idea, but we have nothing to offer. We don't have a research team, we don't have products, we don't have investment teams, we don't have nothing. So it was a period that was very not comfortable for being an asset manager in a growing asset class. So in 2017, I was invited to join an advisory board of a crypto project from California investors. And the project was launched in Macau, among all places. And the things that struck me entirely, we arrived in Macau. Imagine 2017, I came as a traditional banker, very skeptic about crypto. I done my research, and as it was very clearly said, the only narrative was, oh, this thing is going to replace the dollar, and it's going to be the death of central banks and all this. And you could feel that the narrative and all this was, those people, they were a little bit like the Woodstock of finance, right? They were all this great idea of replacing things. Okay, and then, there was a panel of very bright people that were sharing their idea of how it should go and what they're going to do and what they're going to achieve. And okay, there was a panel. But suddenly, this thing was over 4 days. And you had about 4,000 investors who bought ticket. I think it was $75 a ticket. And just to listen to what everybody had to say about this subject. And they were as investors. And I thought to myself, 4,000 people listening to those guys, most of them very bright, now having cryptos that we know of. And I said, this is an audience. There is an audience. So now we have to make a choice. It's either, in 6 months, it's either going to be dead, that's it, we don't talk about it, or it's going to be an asset class. Of course, the path is going to be shaking. We know that. But we decided to go and to say, you know what? We want to offer and want to have an asset management company focusing on crypto because we do not want to be in the situation 20 years ago that we had no solution for something that will change our everyday life. So we started Criptonite in the idea of providing traditional investors with a solution to invest in crypto. We wanted to be regulated. So we asked FINMA in 2019 for a license. They were kind of surprised that we were asking for a full portfolio management license, focusing on crypto. They were actually surprised, supportive, but surprised. And then we wanted to have a structure, we want to have funds, AMCs, certificates, something simple, but something transparent. And our approach was, we do not want to do like crypto firms were doing at the time. We're not here to take the money on our own balance sheet, kind of manage it for ourselves and give some profits to the investors. That's Celsius model. I go back into this. We wanted to be wealth managers. You have your account, you have your fund, you have your things, everything is transparent, we manage the money, and this is it. And then we are agnostic of using custodians and brokers and exchange and everything. The model that we have seen in traditional banking. On the other side of the pond, in Los Angeles, completely separate from myself, was another company was born called Wave Financials. Today we are one group. We merged, and they had a very different approach. The reason I'm saying this is because it's important to understand our philosophy. In Los Angeles, it was venture capital guys, very early into the sphere, ended up in 2017 with having quite a bit of money in crypto. And they were faced with one situation. They say, well, I have all those tokens. I have all those laptops, and that 30 laptops with passwords stick to it anything beneath. And they wanted to have their money managed, wealth management. So they went into local banks and they say, can I give you my money and can you manage it? Of course, you know the answer. So they decided to found Wave Financial. But the idea with Wave Financial was not, as we were doing here in Switzerland, to give access to traditional investors. It was to focus on crypto wealth. They said, we don't want to focus on growth. You remember the narrative with crypto. When you talk to crypto people, they say, oh, I'm going to make 50 times my money, 100 times, 1,000,000 times. Now, it was about, I have that amount in crypto. How can I live out of it? How can I actually generate yield on the crypto I have? I believe that this industry will grow tenfold. Very good. So therefore, I just have to wait and see. But what about, during those years, can I generate yield? So they started to generate yield, combining traditional derivatives, at the time didn't exist, now it does, and all various DeFi, decentralized finance tools. So they became kind of their trademark became that. Today, as I said, I'm going to move on, and we have put together this group. We manage about $1.5 billion. We are ranked, it was in the paper, the third largest crypto asset managers in the US. Funny enough, beginning of last year, there was approximately 12 companies, firms, that were doing about what we were doing. And today, 2. Everybody's dead. Celsius, 3 Arrows, Gemini, Earn, Genesis, whatever you name it, all the bankruptcies, and that has happened last year, with one thing in common. And I rebound on what has been said before, because this is exactly what we wanted to drive in. Everybody wanted to be regulated. Everybody wanted to do things in order to give comfort to investors. Los Angeles, the US was regulated by the SEC, still today, very quickly, very swiftly, and then here by the FINMA. But what I'm saying by that is, all the models we were seeing in the past 2-3 years, they were growing like this, we were growing like that. Why? Because it was a model that says, give me your money. As I said before, give me your money. I'm going to take it on my balance sheet. I'm going to churn it as much as I can. And I'm going to give you some percentage, and you'll be happy. And we met the guys from Celsius. I'm not, judging, but our clients, some of our clients were with Celsius. And they say, but listen, it doesn't make sense. If you go to borrow money at Nestle and they give you 4%, and I have another guy who says, I can borrow money with Nestle and I give you 9%. Is that something odd in here? No, it was fine. Everything was fine. No, it's a new world. So that's the thing that we actually said it's going to end possibly badly. So what does that mean today? All of this story, what we did and this and that and what. We came with this strong assumption. We do not make an analysis, fundamental analysis, is, crypto a hedge against inflation? No, we started to say, hang on, 25 years ago, something changed our lives. And it was about technology. Okay. Today it's what? People say, no, crypto is this odd beast that is doing something. Okay. Well, to me, if I look carefully, exclude Bitcoin, exclude the payment coins. It's not all about the same thing. It's not one basket with everything doing the same stuff. What is crypto? What is it? It's a bunch of guys, software developers, engineers, had an idea, had various ideas. And they said, what? I need $500,000, $2 million to launch my project. Well, guess what? You come to VC private equity. You have a project for $50 million. You find it in 48 hours. You need 500,000 to build the software? Impossible to find it. Too small, too this, too that. Okay. They started to sell tokens. They started to raise the money. They started to say, you guys, developers, all around the world, if you contribute to my project, I'm going to give you some tokens. And guess what? You're going to be able to sell those. And if the project is successful, supply and demand. The simplest logic in having a token, my product is worth nothing, there is no demand, it's worth zero. My product is worth a lot, there's a lot of demand, my token is worth a lot. Simple, right? This is all the start of what is about technology into crypto. And again, forget about the payments and this. This is another type of crypto. Most of it is about technology. So if someone is able to tell me why in portfolio management, as an investment, why are we not capable of saying, well, you know what? This is technology. This is technology. I invest into this one. I don't invest into that one because it's crypto. I think it's a nonsense. It's a nonsense. You saw the rates on the charts that were shown before. The adoption rate, the more and more adoption, users, use cases, everything is in progress. Prices have dropped 90%, on average, 80, whatever. Hang on. Use, price. If something is 10 times cheaper and there are about 5 to 10 times the number of people using it, I think it's pretty good of a bargain, isn't it? So there is something building up. And as it was said, Olivier said it very, very clearly. We are in the process of being normalized, regulated, but organized. Organized. What is a custody? Custody has this. An exchange must have this. Everybody is in the process of accepting and making sure that we live with standards. And this is very good. This is super positive. But let's not forget the point that I'm making, and sometimes I don't understand. We have our client, we don't have individual clients. We only have clients that are professionals, family office, banks. We do help them invest and manage their crypto exposure. And the last thing that come up of all this, like one example before I move to the last point. Amazon is partnering with Avalanche. Avalanche, maybe you know, it's crypto technology. Amazon partnering with Avalanche. If those two companies were in equity world, you would have everybody trying to buy Avalanche as much as they can. Because Amazon needs to move from their model into the blockchain, decentralized model, and they are using Avalanche to do this. And because it's crypto, people say, oh, can't invest in it. Doesn't make sense. It does not make sense. Absolutely doesn't make sense. The last point I'm making, and we're looking at this, asset managers, banks, private banks, what is their case? To grow assets under management. You need to find new clients, right? So there is $1 trillion that has just been made with crypto. So I had a banking partner. He was saying, well, our team is preparing an offer to go after this crypto wealth. And we manage money for protocols. We manage treasury for protocols. We have 20 odds of this. And I was sharing with him and said, look, what are you going to offer? I'm going to offer cash out. Now, they're going to go out of their crypto and they're going to invest in dollars, and we're going to have great dollar investment for them. Well, I said that's not going to work. Because if you want to address the crypto wealth, the crypto world, you need to come with a language that they can understand and they are responsive to. I'm going to invest your Ethereum, your Filecoin, your Schmilecoin, your Smilecoin, whatever it is. I'm going to invest it inside the field and the environment that you are comfortable with. And if we're not, and if the banks are not able to actually make a step and goes towards this, well, there's not going to be AUM for traditional banks from those guys for a long time. And this is what we're saying. It's not about, I'm getting ready. No, it's not about getting ready. This is an ecosystem that has evolved so fast and is evolving so fast. This is the time to partner and to find capacities where they are. That's why we have to ourselves, we partner with you, we partner with many others, because you know what? Everybody develops something great. And the I made it all model doesn't work. But what we have to do is, if we want to really make this, because we are convinced we're faced in front of the opportunity of a generation. My kids understand this more than I do. This is the opportunity of a generation. And this is why you need to have proper answers to proper problems. That's it. Thank you.
And for our final speaker, so we have Christian Zulliger, who is head of Invest and Advice at Bitcoin Suisse. And I think it's going to, again, fit very well because Bitcoin Suisse was founded in 2013, and it's one of the pioneers of crypto finance. And as I said before, a founding member of the Crypto Valley Association. So please welcome Christian. Yes, we have. Sorry.
The PDF, yes.
Tack.
Yes. Let's see. Yes, it works. So, welcome from my side, Chris Zulliger, Head Investment Advice at Bitcoin Suisse. One of the oldest companies in crypto in Europe, as some of you might be aware. Me, myself, I'm looking back to more than 10 years in crypto market so far, and I'd like to give you some takeaways also on the longer term developments within the overall crypto space, crypto markets. So where are we going to head in 2023? And of course, trying to give some insights to the currently hottest question of all when it comes to the market view, is the bottom in. As you might have already seen, we handed out some hard copies of the Outlook. Please make sure, if it's of interest, to grab one. If it's not sufficient copies here, you can easily get one online. First of all, I'd like to step into a long-term macro view, because especially right now, again, we've seen this before multiple times, overall crypto market is heavy correlating mostly with equity markets these days, even more with technology companies as such. Generally, I'm more worried about equity markets than crypto markets these days. And as long as we correlate with equity that strong, it is important to keep an eye on the at least long-term picture of macroeconomic data. Mostly monetary policy, which also historically always had quite an impact on the overall crypto market. We're in funny times, actually, when it comes to general monetary policies from all the central banks. On the slides, it's a 60 years chart to look back in the long term. On the slide, you see the gray bars kind of with major recessions from the last 60 years. Black line is the US inflation rate. Red one is the real yield, US based. Then the green one, the yield spreads, 10-year treasuries against 2-year treasuries, and of course, also quite importantly, the money stock M2 here as a comparison. So compared to the last 60 years, and quite some of it is actually the reason for the latest bull market, so the 2021 bull market. Compared to the past 60 years, we currently have, just as a matter of fact, the most extreme real yield inversion ever since. We also have the most steep incline, so Fed rate hikes, ever since, in the last 6 years. And only for the second time, a negative yield spread on the 10 and 2 years. As we also know historically, the past global recessions occurred when inflation peaked. Check. Maybe. Interest rate hike pivot has already occurred, or at least announced. I would say check. Real yields picked up. That's what we're currently seeing, also on the longer end of the yield curve. Check. And the negative yield spreads are basically there, the inverted yield curve, what we currently see. Also check. So I'm quite worried about the overall global macro picture, even more than I'm worried about the fundamental state of crypto. Secondly, so what's the big picture if we compare equity, as an example S&P, and the crypto market? Here again, these are on the equity side and the S&P side, it's again the same 60 years historically. The upper gray, top gray line, dark gray line, are all the best case scenarios of any bear market in S&P in the last 60 years. The down second gray line, on beneath it is all the worst case bear markets. It's an aggregate of it from the last 60 years from S&P. And in between, the light gray, that's where we currently are in the S&P. So we're still in a bear market best case scenario for the S&P, historically seen in the last 60 years. And that rather worries me, because there's a lot of downside protection here, historically seen. Then on the bottom, the red one, these are from the last 4 cycles in crypto markets. The upper red line is an aggregate of all the best case bear markets for a little more than 10 years now. And the last on the bottom, the other red line is the worst case bear markets we so far experienced in crypto markets, historically seen. And the golden one basically is the current crypto bear market chart, currently sitting at 22.5, not 23. That's data as of current yesterday, more or less. So even also, if we compare it historically with the latest cycles in crypto market, we're in a best case bear market scenario right now, and not in the worst case. What we also can see on the timeline to the right side, that could last for longer. That should also be said. So we're still in the best case bear market, and maybe just like half through on a historical comparison as an aggregate of the latest cycles. That's what the numbers show. There's also quite some positive. Again, fundamentally speaking, I'm very positive on the overall state of the crypto market. Some speakers before have mentioned all the major Celsius, the Terra Luna, the FTX. What's striking here and worth mentioning is that the volume it more or less took with is exhausting. So meaning it's kind of whatever bad news comes, we don't really go lower. Most importantly, we've seen this in FTX. FTX, it should have gone way lower, but it is kind of, there's resistant. It's quite resilient, as we've heard before also. So that's pretty positive. Something to watch out is then also some maybe painful death cross in the next couple of weeks, 250 moving averages, but that's maybe more a bit short term. Question is the bottom in. Trying to give some evidence to kind of try to answer the question. Again, historically, this is a rather simple standard logarithmic regression. So we have a cycle top on the red, on the top end, and the bottom line, the confidence bands around the logarithmic regression. So even historically seen on a log scale, we're pretty down there, which should not mean we couldn't go lower, of course. But the deviation from the trend line is pretty down. Talking about value, are we over or undervalued currently? This example again is for Bitcoin only, to keep it simple here. So what you can see again is the black line log trend line, same one as in the prior chart. Then you of course see the Bitcoin price, also on a log scale, and then the red one, basically the delta, the valuation versus the trend line. And here again, historically seen, going back to 2010 here on the chart, historically seen the kind of green box here has proven to be not a bad timing to start accumulating again. Also, the rather quick spike we've seen in the last couple of weeks in regards to overall crypto prices is something that is not new. We've seen this before. So yes, overall, definitely not a completely wrong timing to look at crypto again. Also something historically worth mentioning is, for the first time, the issuance rate of Bitcoin is lower than the issuance rate of fiat. That's also something that is quite striking when it comes to inflationary assets overall. Things to watch closely, to give some more deep dive here, things to watch closely for 2023, some hot topics that we would say is worth taking an eye on. Layer 2 transactions are now on par with Ethereum transactions on layer 1. Definitely something that might continue. So Optimism, Arbitrum, all these kind of projects, take a look. And then also something striking, something new, which could hold on in 2023, is the very fact that layer 1s more and more not compete with each other, but with layer 2s. That's in case of market competition between the challenger projects on layer 1 mostly, is something new, which we can now also prove with data. So all the Solana's stuff are having hard times against some other layer 2s. It's not just a race between Ethereum and other layer 1s. Yes, that's it. Disclaimer, no financial advice, as always. Yes, and I'm happy to answer questions in the Q&A.
So, I've heard from our technician friend that the mics, you have to keep them very close. Otherwise, start doing like this. Apparently, you get lost. So, thank you very much for all these really interesting insights. Before we hit the Q&A, I have my own questions. So, sorry to make all of you wait a little longer. So, I'd like to sort of go back to the, let's say, layman picture and start where Olivier left us, because he, I think, is one of the only ones who said something with that regard. So I'll ask the three of you who haven't answered that question that much. Maybe Florian did. What are the key features that you would consider when we're talking about fiduciary duty? So when you're talking about investing other people's money, what are the key features that you would look for when you're analyzing specific digital assets? So why would you advise one or the other, and when? Do you want to start from?
Yes, I mean, it basically also starts on the as we've seen before, it starts on the custody side, not to mingle the assets between clients and your own assets, so to say, if you have your own proprietary book. So that is definitely key, absolutely key, to not mingle, to really have separated addresses for each and every client, and also able to prove this. That's important. Most players still can't. Still don't have segregated accounts or addresses at the end of the day on chain for their clients. Of course, operationally, especially for smaller funds, it's not worth doing the separations. So there are some problems still, simply because transaction fees are higher than the operational cost is higher to separate than the actual funds to be separated. But as good as it gets in regards to technology, operational costs, and basically technology and operational, from a pure risk perspective, you have to separate the assets from the clients, from your own, and also separate, as good as it gets, separate the assets from each and every client. Between the clients, not to pool the client's assets, as good as it gets. Yes, that's certainly most important. I think takeaway from Celsius, basically.
What you say is absolutely like I agree entirely. But one thing is, okay, it's not because you're talking about a different asset class that you have to revise the rules, or you have to revise what has worked in the past. I mean, you have a certain discipline for, if I have an equity portfolio that I manage, it is organized in a certain way. If I start managing commodities, or if I gold or whatever, I have the same rules. With crypto, it's not because it's crypto that you have to reinvent the wheel. We just have to take exactly what the principles that are. And that's why when I was saying we emphasize, and we thought we didn't think otherwise, we emphasize in saying, you said, people are entrusting us with their money. So you can't just take the money on your own balance sheet and pocket and just do whatever you want, and then you return it when you want, or when you feel like it's time to return it. That's not the way the game works. You take the money, you remain transparent, you show what the owner of the money is supposed to see, which means what am I doing at every single point in time with your money, and then I invest the money on your behalf, and it has to be separated. And this is not a matter of cost, because if it is a matter of cost, then the business is not sustainable. Then you can't have a business. You can't say, well, you know what, I'm just going to pull these things, right? And because otherwise it's too expensive.
We'll see what happens, right?
Yeah, I mean, just to add to this, I completely agree with what you guys just said. And also, of course, at Sygnum Bank, being a fully regulated bank in this space is still, I mean, back in 2021, it was really, we had everyone coming and saying, like, why should I bring you my money? I'll give it to Celsius. I get 9% returns, APY. And Sygnum didn't really have that much to offer, but after post 2022, I think the value of having this segregation has become so clear and so important that, and like you mentioned, having these segregated wallets where a client can go in and see their wallet address and see their assets safely in that wallet, not being rehypothecated, not being used as a slush fund for the founders, really being trusted and safe. And this is one of those building blocks that can enable broader adoption in the crypto space, because till date, managing your own funds, of course, everyone likes to say burn the banks, we do self-custody, but there has to be a fail-safe to that. I mean, personally, like if I die tomorrow, my husband wouldn't be able to access my MetaMask. He wouldn't know what to do with my seed phrase. So having a counterparty on the other side is quite often is something that you need to have a broader, less technical audience engage. And in this scenario, these segregated wallets is, it's a must-have.
Olivier, you talked about the question of valuation, and you mentioned network effects as one way to look at valuation. Are there, you mentioned you looked at other things. Are there other, let me formulate in this way, are there specific strategies for people looking to invest in crypto, or institutions looking to get into crypto that they should look into?
Well, we're actually looking more specifically at the problem of valuation at the moment. And let me explain what we mean by valuation. When you talk to people about valuation, they go, yes, there's a price out there. What's the problem with value? There is a price. Which is the value? Now, anyone who's interested in fundamental analysis knows that what you're doing as a fundamental analyst is you're comparing the market price with the supposedly intrinsic value of the asset. And if your estimation is that the market price is too high, this is a signal that you should sell. If the market price is too low as compared to the value, this is a signal that you should buy. Now, the question is, what is the fundamental value of assets that may have no cash flows or no balance sheet or no economic multiples to speak of? So this is where the notion of a network comes handy, because it allows to take a longer-term perspective and an industrial perspective on what crypto may bring. If you look at use cases, for example, are we gradually in a position to identify use cases that will have real value for day-to-day usages, right? In other words, can we identify users who will be using Bitcoin or other cryptocurrencies for something else than speculating on markets, right? When that cohort of people will essentially be more significant than the cohort of people who are investing in those instruments for the pure sake of speculation, I think this is where you're going to see eventually a stabilization and a normalization of those instruments. But fundamentals do matter, right? This is essentially what we're telling people in this report. Do look at the business case. What is the industrial value here? What is the economic value that you're proposing to add with that process, that smart contract, or this venture, for example? So going back to basics, I think you were saying, Florian, there's no reason to look at crypto any differently than you look at any other form of economic venture, for example. Go back to basics. Thank you.
One question I'd like to ask all of you, basically, who do you think drives this market? Because there's been, over the years, the narrative keeps changing and depends on where you stand. So institutional and more traditional players would say, oh, this is a retail-driven market. Sometimes the data says otherwise. Sometimes we talk more about whales moving the market. So who do you think drives this market?
There's one thing that always struck me in this crypto industry. It is the first time in financial history that there is an asset class that has been created or came from the retail. If you think of it, never in history something in financial instruments have come from the retail. Usually it's those guys up there who think about a brilliant idea, they use it for themselves, namely hedge funds, then it goes to institutionals. And when the valuation is very thick and heavy, then usually you have access to retails, which basically buy the ticket out of the institutions, right? Sounds familiar. This time, it's all the way around. Those who have started to invest in crypto were the Instagrammers with tattoos and flip-flops. And this is great, because this is what is the essence of a very, very new trend. But this is very difficult for the aristocratic financiers to accept that. And now we're seeing only now that suddenly, okay, Goldman Sachs is stepping in. Goldman Sachs is saying, this is an asset class. I put this in my chart. I'm starting to buy hedge funds. I'm starting to buy... So you have this trend that is coming into play 10 years later. So it is fascinating. So to your question, I think that first trend, who was driving the market? Very insiders, very groups of individuals, whales, whatever you name it, they were moving this market. They were having control of many protocols, tokens, and cryptos. Now, we are seeing the very first sign of institutional entrance. And that goes back to what Olivier was saying. This is about valuation, and people will come with formulas and saying, oh, this is overvalued because it's whatever. And that will come in line. And when the tsunami of money from institution will come into this market, well, it's simple. You can't fit the amount of water in a lake into a cup. So just name it. You have to get a bigger cup.
Also look, if you look at the numbers, for instance, just recently published financial figures of Coinbase, and if you check their revenues with institutionals compared to the revenues with retail for 2022, the picture is absolutely clear. And Coinbase has been a player in the institutional business more or less ever since. So with their solutions, so they service for quite some years quite some large institutions. So clearly, still to a very large extent, it's privately retail, let's say, driven. Most of it, we still see this, the first steps of a larger move from big bag holders, from whales, so to say. Then, of course, all the rumors, the trending, the narratives through the whole crypto Twitter, as always. And then more or less all the retailers step in and drive the market up. Simply speaking. Institutionals on a price power in the overall market, not much yet. It's about to come, not much yet. So yes, it's of course it depends on we have to differentiate between several crypto projects, but simply speaking, for the overall market, it's to a large degree still the large bag holders. But that's no difference in TradFi. If you look at the BlackRocks, the Vanguards, the Fidelities owning 70% with their ETFs, 70% of S&P, three parties owning majority of the bag. It's no different. And even the trend there is in the opposite. So even more centralization of ownership there in the ETF segment specifically. In crypto, it's the opposite. In crypto, it's the ownership, especially for the projects which have been around for longer, is decentralization, even more and more. Not so much for the early, for the newer projects yet, but for let's say, simply speaking, Bitcoin, highly decentralized ownership. That picture changed in the last 10 years.
Yeah, maybe just to speak to your point, right? I think it's really important what you said, because on the older projects and maybe the ones that have sort of been battle tested a little bit, the Ethereums and Bitcoins and so on, you really do see quite a lot of decentralization, and a lot of people, when you think about crypto, they're like, yeah, I own a little bit of Bitcoin. It's still like the first thing that they go out and want to have exposure to. Maybe Ethereum comes in quite close as a second now, but with several projects, and this is what I spoke to in my presentation as well, you really see the large role that institutions have played. And I mean, FTX was part of the problem in that story, right? Where you had a lot of coins, and I would call them even to some extent shit coins. Like they had a lot, if you looked at the wallet holders, the concentration was crazy. And if you know that your asset, Solana, I mean, I didn't say it by name, but if you know that the asset that you hold can be moved by a large institution who's always going to save their own skin before they care about the project or the ethos of building something, you know, innovative, new, and different, that changes what we're doing here. And yeah, I'm glad that going forward, I think that has been identified as a really big risk vector and people are fighting hard against it. I mean, I don't know if you guys remember a project called EOS back from 2017, and it rose and it basically got blacklisted more or less for the kind of centralization that it it supported or it resulted into. And similarly, projects that we see in the market today, we'll see them sort of dissipate now. And the ones that are more decentralized, hopefully, are the ones that we see survive.
In talking about evolution, I guess we've all been mentioning, and Christian showed us the charts comparing with the S&P. Do you think that we're looking to a market that is further integrating into traditional markets, or do you think about this narrative of decoupling from the markets?
When it comes to price action, well, there are phases of decoupling, also to gold, to other asset classes, and then again there are phases of very high correlations to other markets. That's not something new. That's changing. What is even more striking is specifically now that the correlation is very high with traditional equity markets mostly. So that is rather striking. The very fact that there are phases of higher and lower correlation to other markets, not new. That's not new.
I don't see. I mean, the decoupling or difference. I don't see it really logical, because at the end of the day, we're talking about trading assets. We're talking about the same thing. There's always a supply. There's always a demand. This moves along the line. But one thing that is, we talk a lot about volatility and all this, and it's interesting. Some were making a comment in a paper somewhere that 2022 the best asset class was private equity because it fell less. I mean, okay, so no comment further. But the point is, crypto is what? You create a project, you list it. Of course, 95% plus of the project will fail. Sure, but what's bad in it? You have an idea, you will succeed or you will not. Time will tell. But the problem with crypto, which has to be clearly thought, is it is listed private equity. It is nothing less than listed private equity. If you had the whole positions in private equity funds that were listed and marked to market 24 hours a day, 7 days a week, I can tell you that private equity will not be so popular. And that's one of the things. So when we say decoupling, not decoupling and all this, I think it's impossible to have a decoupling. There might be a time, possibly, that Bitcoin, because the holding of Bitcoin will be widespread, that it might be less correlated to the markets and more correlated to gold. I don't know, possibly. But let's not forget, in my view, crypto is a binary world. You have one side, you have Bitcoin, reserve of value, whatever. The rest is tech. That's it. It's tech. It's listed tech companies. And if you had a static portfolio in 99, it would be made of what? Netscape, you will have WorldCom, you will have whatever companies you name it, you will still have Alta Vista and all those guys, they're all dead. Because it's tech and it evolves. And that's why you have to be active into this.
I actually agree a lot with what Florian was just saying. Across all those conversations that we've had with very decent portfolio managers, institutional managers, alternative managers, we have to make a distinction between the coins and the technology themselves, basically. It is possible, some of them were more enthusiastic about smart contracts and essentially decentralized ledger technology as such than the coins that can be in circulation out there. In other words, it is possible to look at blockchain as purely a wholesale bank, interbank level, and improving the processes that make the payments and transfers and clearing and settlement and middle office and back office processes more efficient and less costly without that necessarily getting into the world of retail. That aspect, at this stage, the conversations that I'm having with institutions, is the most compelling argument that I've come across, at least for now. Let's see over time whether retail applications get to develop and become a bit more mainstream. But the arguments I've heard from heads of investments, heads of operations, were very encouraging at the wholesale and interbanking level. That I thought was an interesting development that I've come across. Thank you.
Maybe just to add on to what Florian was saying before, thinking of a lot of the crypto project, or the coins at least, as a representation of the success of the project going forward. I don't know if you all maybe came across this project with the Norwegian government. I believe it's called Brock or something like this. And essentially what they're doing is listing private equity on blockchain. And that's, I think, going to be an interesting addition to seeing how the markets evolve and how private equity then continues to play a role in that as well.
And again, this question of listing private equity and what you just said now, basically it relates to what the Swiss government has done with the ability to tokenize shares. So the easy ability that we have in Switzerland to tokenize private companies. When you look at the Swiss stock market, I think it's about 10% or less than 10% of the, maybe 5% of the companies who are listed, because you need to be big and it costs a lot of money. So that means that people only have access to investing in those companies. So the vast majority of companies are not even investable for most people, and tokenization helps with that. What do you all think about sort of, there's always an evolution in the narratives that are dominant. Sometimes, for many years, of course, it was always Bitcoin focused, and, is it hedge against inflation? Is it digital gold? Is the, NFTs the new thing? Is the metaverse? What do you think is the sort of emerging narratives at the moment?
I would say that Web3 seems to take the dominant part of it, and I think it's the most interesting evolution of it, because it's really what it is. It's all about the evolution of internet. This is all we're talking about, is what we do with a centralized network of internet. And if who owns internet? Well, people say, oh, nobody. Well, that's not true. People who controls the network owns it, and that's why you need to have an evolution into this. And that's it. I think that's very positive, in fact. And the new narrative is this. It's the integration of all of that into something that makes sense to people. And now you see the use cases coming up. Very often you have real life use cases where people were saying, oh, it doesn't, you hear it all the time. Oh, there's no use. Well, there's no use. First of all, what has no use in general? But just even the moving money around. Of course, we are not the target of crypto for use of currency. Why? Because everybody has a bank account, everybody has a credit card, everybody has a setup. Well, guess what? 80% of the people on this planet don't have a reasonable currency. A lot of people, they have lost all their wealth in the past 20 years, about 5 times. So go tell an Argentinian and say, well, you know what, you should trust your currency and don't trust this Bitcoin because it's nonsense. Well, the answer is going to be very blatant. You have the Naira in Nigeria, who is suddenly becoming kind of convertible because you can swap pairs, and they can now trade between Vietnam and Nigeria swiftly in a second. While before, they had to use the US dollar at a gigantic premium and wait 3 weeks to have a settlement of a contract. I say, if this is not evolution, I don't know what evolution is. But going back to narrative, yes, Web3 and the combination of all this.
I would just add that when we discuss with regulators and large institutions, one aspect that gets them excited negatively or positively is that of stable coins, in part related to what Florian was just saying, but also because these instruments, if left unchecked, could become, ironically, what regulators call systemic. In other words, if indeed a big chunk of interbank and interjurisdictional transfers take place away from typical dollar, euro, Swiss or sterling channels, we're suddenly recreating risk in an area of financial system that is entirely unregulated. So at the moment, from a regulation standpoint, the stable coins of this world are catching a lot of attention for lots of probably good and bad reasons, including that, quite frankly, central banks don't want to lose control over their monopoly over money. Going back to what Florian was saying, it is an interesting debate that, I mean, we were discussing with the Federal Reserve themselves as they consider the launch of central bank digital currencies, for example, and we were asking them, why are you doing that? And sometimes they were quite frankly saying, we don't really know, but we were asked to look into that because otherwise the Treasury might feel they're losing control over the main means of exchange in their jurisdiction. So it seems that regulators and central authorities are afraid of playing catch up and losing control over what's happening, which is ironically, when you look at the development of capitalism, if crypto developed, as has been discussed today, it would be proof that you can develop from the bottom up as opposed to a purely centralized take on how economic exchanges are meant to happen. This is pure speculation on my part, but there's an element of fear of the unknown in how institutions are reacting to those developments. Thank you.
I'd like to open the floor now to questions. So if any of you want to jump in, try to speak loud, otherwise I'll just come to you with the mic. And while people are, I was going to say thinking about questions, I had another one, but now it's your turn.
Thank you. Referring about the comparison with .com era and technology, what are you identifying as key trends in terms of technology in the crypto space, and maybe advising your clients?
Well, I think the key trend, really, I mean, make the comparison with internet.com. Where are we now? I think it was shown in the slides. We're now in a stage where I would say we are on the network time. Now we're talking about infrastructure. We're talking about network. At the time, 25 years, you can hear names: Cisco, Juniper, Red Hat, Foundry, Symantec, whatever. There were tons of networks. Some find their places. One became main. Others were becoming side networks. And most of them disappeared. So now we are in the phase where we are still on the network build-up infrastructure, layer 1, layer 2. Then we will have the trend, or we'll have the phase where you put apps on this. And that's when the .com started, really. It was about people had an idea, and they say, I'm just going to do my business on the internet, and I'm going to open up my shop or my app or whatever. There was no app at the time, but then it was an app. The application that we're actually using the network that has been built and offering something. I think we are pretty much at the end of the network, first base network type of era. And then people will say, okay, those networks are strong enough, solid enough, trustworthy enough, and I can rely on, and we will see applications built on it. decentralized finance will be, of course, a big trend of it because people will use more and more of that. And that will go, and it will grow in parallel. So I think this is pretty much what we see now. And we're not yet in the phase of applications. It's too much of an early stage.
I think what we also saw in the year of 2022 was how this focus of the dominance of layer one started to decrease. And I spoke about this in the presentation as well, but what this means is that there's a greater focus now coming into the utility. So building on from the infrastructure side, today there's also new forms of technology that are being developed, and the applications that these can enable, I think that's still very much open and ready for interpretation, right? Like, how are you going to use zero-knowledge proof alongside soul-bound NFT tokens to create really strong decentralized identification solutions? I mean, the possibilities are amazing. And the way incumbents either work with these new technology stacks or people working with these stacks eventually rise up to challenge the incumbents, that's going to be a really interesting game to watch play out over the next couple of years.
Anybody else? Yep.
Thank you very much. Hi, and thank you very much for your brilliant presentation. I learned a lot tonight. I didn't understand all of, especially Christian, I didn't understand all of what you said and presented, but I will focus on that, and thank you for that. I wanted to say something about the testimonial first, and after I got a question. The testimonial is, I'm Chris, I'm a CEO of Spotis. It's a very early startup stage, and the testimonial is about we are about the collaborative platform. What's what we are doing about it, and specifically in mobility. And for the last 6 months, with my associates and friends, we are on very traditional business and traditional startup business. And I decided 7 months ago to say, okay, everything is okay, but there's a lot of things to say and to expect about blockchain, because some friends of mine are very specialized in this. And we decided to, because we are currently doing a funding about it with NFTs. So I'm really surprised, because I'm learning this topic and I'm learning blockchain for the last 7 months. I'm very surprised about the blue ocean strategy, but because it's a blue ocean market with blue ocean people. And what we are doing collaborative app, a collaborative platform, and we need blue ocean people for that. And what is very interesting about the NFTs, and Aliya, you mentioned it, and I was very happy to know that we are doing funding through NFTs because it has to make sense to the investors. It has to make sense from the bottom to the top. And that is the real perspective I'm doing. I'm responsible of that. It's to make sense to our investors, customers, but partners, to say what is the NFTs, what is the sense. It's a new tool, but it's not a new rule. And I really agree with you, Florian, sorry. And we can play with that. We have to structure it. We have to organize it. That's my responsibility as a CEO. But there's amazing and creative tools about that. So my question, it was my testimonial, and thank you to give me the microphone. My question is, how with those new tools, because I speak about NFTs, utility tokens are amazing, but it has to be regulated, it has to be structured, it has to be really, what is your perspective and how you know that about the utility tokens or DAOs, because I believe a lot in that, because it involves a lot of people, and connecting people is with the decentralization, it was your question, with Web3, is of a real matter and a real perspective we have to answer, and I would like to have your opinion about that. Sorry, it was long and maybe not so clear, but I can be.
So, I think the use, the utility, the regulations, all of this, nothing will be able to be regulated at once. I mean, in one bulk. That is not possible, because there is a different aspect, different use case, there's just different type of equities or asset class. There's different assets. NFT, as an example, we all come to mind that, NFT is, yes, monkey on the wall, yes, this bored apes, all this, all that. But NFT as a concept it's phenomenal. Non-fungible token, unique digital identity. And, I give you just one example. It's public, so it's known. We manage a lot of money for the Cardano ecosystem and Charles Hoskinson himself. And we made a deal with the government of Ethiopia. What does that matter? Because we made the blockchain and for the NFT. Because we realized, and they came to us, in Ethiopia, it's a 100+ million country, people. 1% of the people, 1%, have the chance to go to university and have a diploma. And guess what? The challenge they face once they have that diploma is to convince the future employer that the diploma is real and is not fake. That is their priority, and lots of them struggle to prove it's right and it's a true certificate. Through NFT, you triangulate blockchain, NFT, app. I come to you, I have my diploma. Show my NFT, it's a true diploma, period. That cannot be regulated the same way that you would regulate something that is a token for payment or something that is a share of value or something tangible. So there is a whole spectrum of things that will take time to regulate and will take a lot of efforts. But I think that the regulators should take the easy case, the low-hanging fruit, as we said, and try to regulate things that looks like securities. What, at the end of the day, it's, if it looks like a rabbit and smells like a rabbit, it might be a rabbit, right? So.
I can speak for a minute on, you mentioned utility tokens, right? And these utility tokens, you get to raise capital using them through the concept of initial coin offerings, right? ICOs, and ICOs are a major part of the new European regulation, the markets in crypto assets regulation. It is interesting, going back to what Florian was saying at this very moment, 2 years ago, more or less, the SEC in the US came out and said, exactly as you said, it looks like a security, feels like a security, we're going to regulate it like they are securities. Guess what? There were no ICOs anymore in the US, right? There seems to be some sort of connection between the ease and the laxity of the rules and the propensity to launch those ICOs, for example. Whereas in Europe, they seem to be a major component of what governments and regulators are interested in pushing. In other words, finding new ways to raise capital. As you know, Europe is much more intermediated by banks as opposed to the US, which has been decoupled, disintermediated for a while. So it is possible ICOs might be a solution to raise capital more easily for small and medium enterprises and new entrepreneurs, for example. So there's a lot banking on ICOs and utility tokens. But again, if there are major differences in how regulators perceive those instruments to be, we're going to be facing a situation where regulatory arbitrage may lead to quality concerns in terms of where you want those listed and the reason why you want those listed. If you go back to FTX, why was FTX in the Bahamas, right? Well, asking the question is sort of answering it. So that will need also to institutionalize and normalize to some extent. But there seems to be a lot of potential on the ICO front, at least in Europe for the time being.
I think what you were saying about regulatory arbitrage is actually something that we already see quite actively happen in the cryptosphere. And with any, let's say, ICO or any token that you want to buy, you have to first declare like 15 times that you're not in America, you don't have any relationship to America, you have no friends in America. It's really, really quite stringent. And I noticed this also when I was at the Permissionless conference last year. All of the projects that were being displayed over there, I didn't really know them very well. It was almost as though it was a separate crypto universe. And so having this sort of like fragmentation between the regulatory zones causes a really strange approach, especially to something that's meant to be global and decentralized and not bound by jurisdiction fundamentally. Like we have teams that are so decentralized that you have a guy in America and a guy in Australia, but the guy in America has to actually have a separate representative sitting in the BVI to actually legislate for him on all of his project outcomes. And in Europe, I think because we have this utility framework, we have the payment tokens, and then you have securities, there's at least clarity to some extent that between at least utility and payment tokens, there's a lot of flexibility on being able to have a project and drive that project forward without having this incredibly overbearing weight of having to go through the securities route. Having said that, I think the securities route is where we will see growth as well going forward. It's been sort of in the offing. Everyone's been waiting for it, waiting for this wave of like securities to happen to crypto. And I think since at least 2017, there's been a lot of talk about this, right? But even today, like at Sygnum, we have a tokenization platform where we do art security tokens or other different collectible tokens. But because of all the weight that is carried by a security token, it becomes really hard to distribute. And so sort of bridging that gap, enabling people to participate in providing them access to things like a Picasso painting is something that, in the year 23, 24, hopefully it gets to open up a little bit more.
That's definitely a positive aspect, to have more clarity on the overall regulatory side. And yes, let's hope that it's not like in TradFi, it's America and the rest of the world. Let's hope it doesn't turn out like this, because it's a global thing, the whole crypto. Yes, maybe also in regards to token sales, ICOs. The whole business model basically completely shifted from the early days, like the first one, Ethereum back then, to the current security token offerings. The whole business model completely, but not just because of regulatory issues, also because the very need of these projects in order to use token sale to raise money, to raise funds for the project, that their own need, it has shifted from a pure crowdfunding kind of perspective into we need just something to sell to a VC company with usually these days very limited amount of different kind of VC companies. So they all go into the same projects. And that's something that is a trend. We should shift to the other side again, to the crowd sale, more decentralization of ownership side. Else we end up with even more regulation at the end of the day.
Well, thank you very much. We're running behind on schedule, so I'd like to conclude here. I'd like to invite all of you actually to join us at a little, it's called a cocktail dilatoire, so just some food and some drinks. Follow everybody. We're going up one stairs, if I'm not wrong, and across the corridor, but there shouldn't be anybody else in the corridors, so follow our friend from the team and just follow everyone. Please join us and keep talking.